Welcome back, future chartered accountants. If there is one chapter in CA Final AFM that can single-handedly break your paper, it's mergers and acquisitions. Every single attempt, ICAI tests you here, whether through a heavy 16-mark practical question on swap ratios or tricky conceptual MCQs. Today we are breaking down the core framework of M&A into a high-yield 8-minute capsule. Grab your calculators and let's dive straight in. Let's start with the absolute heartbeat of this chapter, the exchange ratio. When Company A acquires Company B, how do they decide how many shares to give? It usually boils down to 3 parameters: market price, earnings per share, and book value. Rule number 1. Always check whether the merger is EPS dilutive or EPS accretive. If the post-merger EPS is higher than acquirer's pre-merger EPS, existing shareholders love it. If it drops, it's dilutive. Let's look at a quick exam trap. ICAI often asks you to find the maximum and minimum exchange ratio. The maximum limit is bound by what the acquiring shareholders can tolerate without diluting their wealth. The minimum limit is bound by what the target company shareholders will accept without feeling shortchanged compared to their shareholders' value. Next up, synergy and valuation. Mergers don't happen just for fun. They happen 2 plus 2 logic equal to 5 logic, cost savings, revenue enhancements, or tax shield. When computing the post-merger market price of the combined firm, remember this golden rule. Do not blindly apply the acquirer's old PE ratio. Why? Because the market often re-rates a larger combined rate entity. Read the question carefully. Does the problem state that post-merger PE remains constant, or does it have a new PE? Your entire valuation of the market price, MPS equal to EPS by PE, depends on this distinction. Secure those easy marks by not making this silly assumption mistake. Next is don't ignore the theory. Practical questions get you through the door, but theory gets you an exemption. Focus heavily on takeover defenses. Ever heard of a poison pill? It's a strategy where a target company makes its stock looking unappealing to a hostile acquirer. Example, by allowing existing shareholders to buy stock at a massive discount. What about crown jewel defense? Selling of the company's most valuable asset to the raider loses interest. Also pay close attention to demergers. Understand how liabilities, assets, and reserves are carved out. How shareholder value is unlocked through mirror image shareholding. To wrap it all, M&A is predictable if you practice the variety of questions found in the ICAI study module. Focus on your working notes. Examiners love step marking in this chapter. If this quick revision added value to your preparation, hit that subscribe button. Share it with your study buddies and drop a comment below telling me which AFM chapter you want next. Work hard, stay focused, and go clear the exam with an exemption. All the best.